Welcome, everybody. I am David Asman in for Neil Cavuto today. Our top story, it's got to be Apple, right? Making history, becoming the first trillion-dollar company. Let's get reaction from market watchers Jonathan Hoenig, Lenore, Hawkins, and Michael Robinson. Jonathan, first to you, does this change anything in the minds of investors about what Apple is and what it's worth?
Well, David, to me, this is very much like the celebration of Dow 10,000 or Dow 25,000. It's an arbitrary number, but it is an indicator of just how far and how tremendously successful Apple has been. And it's indicative of really what has been the leadership in this market, and that has been these FANG stocks. Apple, of course, is a big part of that. So I celebrate it, but I'm a little worried now moving forward because we've seen a lot of those big technology stocks fall, even as Apple continues to notch new highs. Great success for the company, but I think it's a reason for caution for most investors.
Well, and actually, Lenore, it has come down since it hit a trillion. It's come down about $3 billion. But again, that's not much when you're talking about $1 trillion. It's extraordinary, Lenore, that $3 billion is just an accounting error for this stock.
Remember when $1 trillion, that was one of those unfathomable numbers. But I completely agree with Jonathan. In fact, year to date, the FANG Plus stocks, the NYSE FANG Plus index, those stocks, there's only 6 of them, have accounted for about 2/3 of the S&P's gains year to date. Just 6 out of 500 have counted for 2/3. That is a cause for concern because that's a really narrow leadership.
Michael, a lot of investors do remember back to the lazy, hazy days of the late 90s when we were reaching new highs on the NASDAQ all the time. Some people said the sky's the limit. Well, it turned out it wasn't. There was a limit, and the bottom dropped out of that market. Is it conceivable that there's too much pie in the sky talk right now?
No, not at all. We're in the midst of what I call a convergence economy. We've never seen technology, all these overlapping rings driving things forward. The American economy now is a tech-centric economy. I think Apple is a great symbol of exactly how important technology has become. Every business today is a technology business. Consumers you just can't get by without technology anymore. We are way past the tipping point. That doesn't mean we won't have some sell-off and some corrections in there, but we're not talking .com. I mean, I've had this question come up as a big tech bull, especially with Apple, come up several times over the last several years. I do not see anything remotely close to a bubble in the strict sense of the term, what we saw with TechCom. Just the opposite with the .com boom. Just the opposite, in fact, David. This is a great convergence economy, and you should be in technology, that's for sure.
Of course, it depends what kind of technology, Jonathan. There are some companies that get stuck at the end of a chain. Some companies get stuck at the end of whatever it happens to be, whether it's digital or whatever. But Apple is staying on the front lines, getting right in, as we heard. And Apple services are doing extraordinarily well. Of course, cloud computing is so important now as people switch from televisions to their handhelds for just about everything. So they really are at the cutting. They make sure that they're at the cutting edge of that technology boom.
Yeah. Yeah, and that's why they've been successful, David. Not because of a handout or a stimulus product, but because Apple not only gives the customer what he or she wants, they anticipate it. They invent what the customer wants. I mean, so much of Apple's business now, I believe upwards of 70% of their revenue comes from the iPhone. This is a product that didn't exist 2 decades ago, in effect. So that's what keeps Apple successful.
Right.
And, David, that's competition ensures that a monopoly isn't assured in a capitalist system. If Apple doesn't keep that competition up, someone's going to eat their lunch.
This is proof that competition works, even though we're focusing on one company. You think of all the ancillary companies that are not only involved with Apple, but that are competing with Apple. Lenore, there's another thing, though. Besides technology, we've got to focus on the gross margin of this company. I live in New York. I was just talking to a friend who has a restaurant in New York. He says he's lucky to get a 5% gross margin on what he spent. That is a profit of 5% after you pay out everything you have to pay out. We have a company here which has a 35.6% gross margin. I mean, that has a lot to do with why it's such an expensive stock, right?
Oh, it's incredible. Its gross margin is phenomenal. But if we look at the broader economy, yes, your other guess is correct that we do see a lot of technology pervading everywhere. However, we're not seeing that translate into productivity. The most recent employment cost index out of the Bureau of Labor Statistics showed employment cost is rising at 3% year over year. Now, that's the fastest we've seen since the financial crisis. That's great for employees. but productivity is rising a lot slower. That's bad for investors.
Explain, hold on a second, Lenore. Explain why that's bad for investors.
That's bad for investors because what that means is that companies are having to pay more to their employees to get less out of them. That means pressure on your profits. That's pressure on the bottom line.
Well, Michael, does that concern you?
Not at all. I'd like to see more productivity, but we're seeing companies adopt technology en masse. You talk about the cloud. Just nobody can get by without cloud computing. Look what Amazon has done with Amazon Web Services. What Microsoft has done an amazing job in moving to the cloud. So no, there's no slowdown in the pace of tech adoption. Again, I would like to see a little bit higher productivity, but we're getting a different kind of productive shift. I mean, you're moving all these IT departments out to the cloud. That's massive right there. And there's a lot of money to be made in these kinds of stocks.
That's true. It's hard. I don't want to get too in the weeds, Jonathan, but the fact is that when productivity goes down, it's an inflation concern. That is, if you have inflation, one of the best ways to lick it is by improving productivity. We already have inflation kind of licking at our heels here. With lower productivity, might that make that even more of a problem?
David, I think you make a tremendous point. I mean, think about Amazon, for example, how effective this company has been at keeping costs down for everyone, for consumers of big and small. So you're absolutely right. And to Lenore's point, these companies are successful, listen, but they're also priced for perfection. And look, it's not like technology went away after the year 2000, but it faded from being the leadership stocks of the era. So we used to talk about Cisco and Sun Microsystems and Oracle, and then we didn't talk about them for about 14 years. I fear that's the era we're in right now, and these big cap tech stocks are going to be dead money for quite some time.